we were very happy with the performance of that first LP investment. And we just kept on going down that path. And then I quit my career in 2019. Jennifer, a couple of years later, quit hers. And this is what we do full time.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. We're excited to have Spencer Hilligoss. Spencer, how are you doing today?
Doing great, Todd. Thanks so much for having me here. Honored to be here.
Definitely. Well, I appreciate you coming on the show. Spencer is the CEO and co-founder of Madison Investing, which is a real estate investment firm that specializes in real estate syndication. So listeners, you're probably pretty aware of that. So we're going to dive in. As a passive investor and active syndicator, Spencer understands the unique challenges that busy professionals face and, can relate and dive in and help people starting out in that kind of journey. Spencer's mission is to arm investors with the know-how they need to have in order to make those decisions. So Spencer, with that, I just want to let you kind of dive more into your background and give our listeners just a little bit more color, kind of where you came from and what you're doing today.
Yeah, happy to. And the year 2023, man, as an investor, passive investor, active investor, whatever side of the world you're on, it is a strange and disorienting time. And so more important than ever, right, to educate oneself and just connect with other folks that you respect and appreciate. So thanks again, Todd.
Yeah, absolutely.
So I'm based out here these days in the Bay Area, California, little island city tucked right next to Oakland and San Francisco. I lead Madison Investing, which is like a passive investing club of other LPs, other passive investors. And never in my life did I think I would end up sitting in a seat like this, full-time passive investor. I grew up in a real estate household. My dad was a real estate broker, residential, Bay Area, without giving you the whole life story. He had me working open houses as a teenager. Before that, I was doing just odd admin and stuff, cleaning a fridge. That was super gross to like a kid when he was having to do the dirty work for that. All that to say, I ran screaming away from that into tech companies when I was old enough to work, and somehow found myself in a 13-year career. So that's what I did for the lion's share of my career up until 2019 when I retired. Before it was cool to do the whole quiet quitting thing, as they'd sound branded.
That was a pre-COVID.
Yeah. So this was actually, it was about 5 months. 5 months before COVID hit the airwaves and all of us globally. In hindsight, looking back, that was leadership gigs, growing teams up to 200 people and managing big groups in customer experience and sales and support teams for fintech, financial tech companies like Intuit that makes QuickBooks, TurboTax, all the rest. And that journey was never expected. I never wanted to be a manager, never wanted to be a leader. I was just trying to, go play in some punk rock bands and metal and have fun when I was a kid, and hence all the tattoos. All that to say, though, here we sit. We just got back from spending 6 weeks living in Sintra, Portugal, on the other side of the planet. Never done something like that. Brought our 2 young boys, my wife and co-founder Jennifer. She's the COO of our company. And I share all that context because the from to, when I look back in hindsight, like everything else in life, Todd, right? I mean, hindsight's 2020. But as you're chopping your way through decision making, a few years ago as a father for our first and then growing our family to have our second kid, I was grinding so hardcore within that world of tech companies. I was working 80 hours a week in office and celebrating my maxed out 401ks.
Yeah.
Feeling great about that. In hindsight, I remember the day literally when I said, okay, well, I'm going to turn off my contributions to my 401k today, and that was a scary thing. And man, now that seems silly and I laugh at it, but.
Were you investing? Like, why did you turn those contributions off? Were you investing heavily at that point in time in real estate? That
was like right on the brink, right? I think that was right around the brink of where it was like, we had already bought at that point a duplex. And we went through it, in hindsight, I can framework it in a three-phase journey thing here, but again, not clear at the time. Bought a local duplex around that time, $430,000, Bay Area duplex. That's a California price point. This is not, and that's higher now, but, putting over 6 figures of down payment into that, thinking I knew what cash flow meant. So that was around the time I turned off my contributions to my 401k because I was like, there's better ways to do this.
So you just said, hey, I'm not financially, you weren't there yet. Maybe you didn't have all this big amount of real estate, but you're just like, look, this 401k is not doing it for me. I got to take that money that's allocated to the 401k and I'm going to put it into real estate.
That's right. I mean, and we as in Jennifer and I had our own distinct careers. We had been doing great on W-2 income. We worked our butts off for that. Right. And all that to say, like, I looked at the math. I looked at the math after I devoured 24 books in an 18-month period, which is way more than anyone should go and read. It's overkill. I was procrastinating after the third, right? All that to say, though, I looked at the math and I thought, well, I have a younger son, not soon after, wait a second on the way. I didn't see an off ramp from that. You know, folks join Silicon Valley tech companies because they, in the back of their mind, whether they say it or not, they want the Silicon Valley lottery ticket to go. They want the next Google. They want to be early team member of the next Uber. You know, pick a big exit company.
Yeah.
And I just saw that the math wasn't working out. Why should I keep dropping money into a 401k at this companies and working this hard if I can't spend time with my family?
Yeah.
If I don't see an off ramp for that, if I'm not insulating my family with a financial moat, best metaphor I can think of, something. And so we went from that duplex after we realized, damn, that 100K went out the door pretty quick for $200 a month in cash flow, which is a huge win, Todd. I mean, in California markets for cash flow, if it's net
$200 a month.
Oh yeah, it's gone up. You know, in all fairness, it's gone up a few $100,000 appreciation, but it's an appreciation.
Sure,
play, you know,
sure.
And I didn't get that at the time. So then we got up to, think of it as phase 2 of a 3-part phase. It was buying up to 5 single-family rentals in the Midwest. Got those in Kansas City.
Turnkey?
200. Those were turnkey. Yep.
Turnkey.
Smaller, newer provider, but I was able to back channel vet the heck out of them just because of some relationships, and I'd met the partners before. Okay. And $250 a month average cash flow for 60K per purchase price on average. That's pretty damn good. All that to say, though, didn't know what it meant to have your annual turnover in C-, dare I say, maybe even D+ neighborhood.
Yeah. Yeah.
And so there you go. We kept them. They were pain in the butt. Rentals are semi-passive, as I will put that stake in the ground and say, at their best, with a great property manager, a rental is semi-passive at best.
And these are turnkey. That's key right there, because a lot of people think they're going to go buy the duplex, go buy the single family houses, and it's going to be passive because they've got a property management company. Now, this is turnkey. This is already renovated. Everything's set to go. Property management company in place. And you're telling me it wasn't passive.
Very well said.
Yeah.
And it was not only not passive, you know, you get those notices from the county or the city, usually the county, saying, hey, there's this couch. Hey, there's this couch on the lawn of this property. Turns out you're the owner. What's with this couch? And you're like, why are we getting this?
Yeah.
You know, and then there's like dozens of other things you got to deal with, the property tax, et cetera. And some people who are active might say, that stuff's easy. It'd be like, you're deep into it. The folks who typically have that reaction, like, you know, like yourself and myself, are deeper into this stuff than the average person out there.
Yeah.
We were still working full time, and I was leading teams of people. I had to wake up in the morning, do my job before the job to take care of the property stuff along with Jennifer. Right. And so anyways, we went through that journey.
And that stuff is easy, right? It truly is. It's not that much work, but it takes time away and it takes emotional damage. I think that's the thing that people forget about. Is like when I still own a bunch of single families and I've sold a lot of them. But when I get a problem with a single family, I'm just like, oh my gosh, I don't want to deal with this crap. And it's not even that much, right? But that's not what my focus is on today. Right. So it's like, this sucks. It's like, wait a second. A letter came to you about a couch on your lawn. Like, why is that so bad? But it's just an emotional drain on you. You have to think about it. You have to stop and figure out how that problem's get. And again, it's not that much time. It's just, is that really what you want to spend your time dealing with and thinking about?
And you just articulated it so eloquently on the damage of the context switch, right? And it's not just, oh yeah, is it hard to field an inquiry that says like, hey, go get this couch off this lawn? Is it hard to go and pay a property tax bill administratively, assuming you got the cash, you know? And no, these are just activities that are adding more admin to the pile. And that's the whole point. We wanted to be that, we thought that was passive. Passive to me means very low touch, if any, once you're in that, once you've allocated that capital. So we bought and sold. We actually ended up selling all 5 of those at a profit. Well, it wasn't some huge home run, but it was a profit. Then we entered phase 3, and we were still working full time. This is back in about 2017, 2018. We invested in as LPs in a multifamily deal. And at that point, I was actually working in the guts of the what was at the time, may still be, the biggest fix and flip bridge lender in the country. That was Lending Home, now rebranded Kiavi. It was a great experience, man. And I saw the numbers on those deals on the inside, right? As I was leading the teams of origination, doing 600 fix and flip loans a month. And so as an operations leader in fintech companies, I got the math. I can't swing a hammer for anything, man. I use YouTube every day to try to save me on that one around the house, but I got the math, and I looked and said, I don't want to be a flipper, but I saw how much that some of these folks within fix and flip scale businesses were doing. And I was like, I just got to get more active in this stuff. I got to dive into it. And that's really when I started to look more at the bigger properties, at the commercial properties, at multifamily specifically, and later storage. And that clicked for me in a much more meaningful way, because I just got all the things that you've talked about. And I mean, frankly, and I've heard really, really wonderfully experienced and intelligent people on your show in years past, Todd, talk about the merits of these asset classes. So I don't need to rehash that for folks necessarily, but predictability, there's just more of it. All those things clicked with me as an operations guy.
Yeah.
Like if that same 100K that I dropped into that California 430K duplex for $200 a month in cash flow, that doesn't come along with the same type of tax benefits that I get now if I make an investment into an LP spot. Way different, right? And so, and frankly, you front end the due diligence on these things. Like when I look at the subscription documents, the legal agreements, and I just decide, is that a great deal? Once I've done that, if it's with the right team, there isn't the couch notification that I get. Yep. I don't get the property tax bill.
Yep.
Yes, for sure. We were very happy with the performance of that first LP investment, and we just kept on going down that path. And then I quit my career in 2019. Jennifer, a couple of years later, quit hers, and this is what we do full time. So that was a long-winded way to get through that. But I would just say that it's a common journey, and it sounds like you've gone through your own single-family journey as well, Todd. It's a interesting hashing through of decisions and figuring out really what is lower touch in the world of passive investing. But now the real challenge in 2023 is like looking across a more confusing landscape than ever of where to really think about and discern what's a smart place to deploy capital. And we also just as recently as yesterday, talking to a new member of our investor group, and he's asking me for like, what do I think about folks who are getting in to do their first one right now? And it's all just comes back to fundamental principles. It's like, take your time. I would take my time. I would educate myself. I would look past asset class first, and I would think about what is my goal.
Yeah.
And I give myself that personal advice as I look across the market right now.
Are you asset class agnostic? Like, are you paying attention? Is there certain ones that you say, I'm not touching this, or I love this one?
I am very biased toward multifamily, very biased towards self-storage. So I wish I could say I was truly agnostic. I can't get away from the wisdom that was shared with me by a mentor back in my corporate career. This is years ago, not a real estate person whatsoever, but just really, really ushered along my journey. And they said, double down on the things that but just be aware when you start stepping outside into areas that you don't, and focus on what stick to, and then lean into those strengths.
Yeah.
And so I know multifamily, not as much as a hands-on active operator who's boots on the ground, but I know it well. And I've walked dozens and dozens of properties across a dozen different states in this country. We've partnered on 45 different deals at this point actively. I know these asset classes. And so I love the merits. A few of the ones out there, I just don't necessarily want to bring myself to jump into a deal unless I really understand the big picture. What's the demand for the asset, and what are the drivers behind it, and how to operate that thing at least well enough to know how to vet the person that's managing it from afar.
Yeah. That's a good point. Yeah, I think I think it was Gary Keller in the One Thing. He talks about taking, instead of, people say, don't put your eggs in one basket. And he says, well, put your eggs in one basket, but protect that basket really well. And it's kind of what you're talking about. Like you could invest in every single asset class in real estate. You could go and do syndications that are oil and gas and ATMs and, all kinds. There's so many things out there, right, that you could be bringing to your group, but you're protecting, you got the basket or baskets, and you're protecting them. You're saying, this is what I know, right? This is what I'm going to focus on. I'm good at this. Like, I know how to look at these, and I don't necessarily know how to look at those as well. So let's focus on these ones.
I think you nailed it. I mean, and even if I think about a couple other wonderful asset classes, ones that you probably are very familiar with, right? Like I look at ones such as like senior housing. Man, the big demand driver is they're so clear to me. And I'm not pitching the asset class here. Like I actually have no financial ties into any of that stuff right now currently. But I would just say I look at that, and that is I've circled that so many times and looked at it going, wow, there's going to be, and there already is, an incredible strong and growing demand in that space, right? Just to give a shout out to that asset class, because it's like, but then again, I'm not sitting down and going, let me go read that stack of books. Let me go deep into the underwrites on 500 different deals for a couple different of these very specialized, very complex, nuanced asset class. Until that moment happens, and I'm prepared to go do that, and I'm using that purely as an example, then I don't know if I feel comfortable sharing out that type of asset class for other people in our investor group and saying, hey, look, we believe in this team. We believe in this deal. Here's why. Here's not just the quantitative, but here's also what we see in the playbook and the competency and the track record for the team that's going to be operating that asset. Same principles apply at the highest level, whether it's multifamily, whether it's self-storage, whether it's mobile home parks, down the list. I mean, oil and gas and beyond. Just try to stick to what I know. And then when we decide to go do something new, like medical office, we did some medical office stuff last year. It went very well. But I would say that was a big thing it was a momentous thing, dare I say, for us at least, to say, we're going to go and put a stake in the ground to go do one new asset class, and let's go learn it really well as we lean into that with the right partnerships and find the right people who can run these things well. But multifamily and self-storage, man, those have been the key focuses.
Yeah, I think that's super important. Like we already said, you could go and do everything. You can invest in all these kinds of asset classes, but what you don't know, you do know that senior housing, for instance, has explosive growth that's going to be happening over the next 20 years. I mean, it's going to be amazing, the explosive growth. But you don't know, unless you dig into it, you don't know what the pitfalls are.
Right.
Where can things go wrong? What happens with multifamily, what happens with self-storage. Now, what happens with medical, what can go wrong with those asset classes. But if you don't know anything about senior housing, you just go, wow, look at the demand drivers. This is going to be an amazing asset class. And you go, I'm going to invest in this asset class. And you don't realize what the pitfalls are. You're not protecting your investment. You're not protecting your investors, because we don't know what can go wrong.
Totally. Absolutely. And like, I forget who said this, and I'm going to butcher it, but it's not the known dangers that hurt you. It's the unknown unknowns. Right. And I think you just kind of hit that as like, if your radar, if we all had the radar, figuratively, if our radar is not tuned to see all the risks of something, because we don't even know enough to know what those risks are, then we're going to get ourselves in hot water, man.
Yeah.
And that's the stuff that keeps me up at night. Right now, looking at the landscape of 2023, a fascinating thing's been happening, just to share it proactively here, is like the first half of this year, I think all of us were sitting there kind of going, wow, the landscape has changed immensely in terms of, passive investing, real estate, certainly anything tied to floating rate debt and bridge loans since the first half of 2022. Now, looking forward, what's fascinating, and this is just really fresh, so that's why I wanted to share it, is like talking to folks, fellow LPs, fellow passive investors, in the past 2 to 3 weeks in particular. There's almost this acceptance of the new reality positively. And I'll say that the new reality being that, it looks like the sky is not necessarily falling as defined by a major black swan event, knocking on wood right now. I have no crystal ball.
We don't know, but the sediment is.
Yeah, we're purely talking sentiment, right?
Yeah.
The acceptance of, well, the sky didn't fall. We're all kind of waiting to see if it does. But now at least every headline out there, which is like not exactly the most helpful guide ever,
Yeah.
is making it sound like something like a soft landing. But there's really interesting distressed stuff popping up. Like there's really interesting assets that are, you know, potentially going to be great acquisitions and therefore great investments that are starting to show up. And it's because of, you know, the ramifications of, you know, the higher interest rates. And so that is very interesting for those who are willing to look beyond the headlines. And that's where I try to live in terms of, you know, evaluating the landscape now and just asking the questions back to, you know, core principles as a passive investor. And when people ask me for my input from our group and they're like, what would you do now? I'd be like, well, same way I start any month, any week, any deal is like coming back to what is the goal for the money? You know, like what's the goal for the money? Because we all get so wrapped up in the details, we get so wrapped up in the headlines, we get so wrapped up in one specific asset class. We skip right over this core question, and it sounds simple, but it's not. The smartest people, we're talking brilliant people, way higher IQs than me, man. They'll sit there and say, "Wow, but what that IRR looks way better on that deal than that deal." Be like, "Well, why are you even investing in all these categories in the first place?" Let's talk about that.
Yeah, right.
You know, to the person making $400,000 a year W-2 income, you know, keeping them anonymous, like he's sitting there going, "But I need cash flow." Be like, "Why?
Why? Yeah.
Are you quitting? No. Are you pivoting? No. Do you like your job? Yeah, enough. Cool. Then you're trying to preserve your capital, it sounds like. And it sounds like you're trying to get a good risk-adjusted return." And they're like, "Yeah." Be like, "Cool. I'm glad we're aligned that cash flow is not a priority for you currently in your life. Now go and click down to the next step," right? It's the core fundamentals about looking across the market that I think so many of us, including people that are brilliant, but man, do they overanalyze the spreadsheet before they even come back to that core principle of what's the goal for the money? Someone on their investments personally.
I think a lot of it comes down to like you were just told to do something. Like you were just told somehow you read something or heard something or whatever, and you heard that cash flow or heard that appreciation or heard whatever it is, and you're like, "That's what I need."
Right.
And you don't even think about like, what am I really trying to achieve here? What is my goal? Because your goal is totally different from somebody else's goal. And that's what we find like when we're buying apartment buildings and we're off by 25%. We're like, how did they buy that apartment building? Well, because they have different goals. They have different sources of money. There's just differences. And that's why they were able to pay way more than us. Or maybe they're stupid, but whatever.
Could be either.
Could be either.
We don't know.
Yeah. Yeah. You're in a lot of investments as an LP. You've got this investor club, which I want to dive into in a second here. And so you see a lot of deals. You hear about a lot of deals. You know a lot of sponsors. I'm not asking in particular in your deals because you don't need to disclose what's happening in your deals necessarily. But as you're looking through these deals in the market and what's going on and talking with people, are you seeing deals that are struggling, having, you know, capital calls, potentially going to go into foreclosure or have a fire sale? Are you seeing that right now in kind of your eye view?
You know, I'm knocking on the wood on my desk again here. I'll just say we have in our own portfolio, we've had zero capital calls, zero anticipated capital calls.
Wow.
Grateful for that. Pause distributions. Oh yeah. You know, that anyone that's out there that actually wants to do their homework on that will find out that can just be a responsible, smart decision.
Yeah.
If you have floating rate debt and a deal structured to weather this moment, come out the other side, okay, because they have good NOI. So all that to say, I mean, even just right now, I mean, I'm not plugging a deal. The deal is working on one right now. It's a 506C. That's why I can even talk about it anonymously here, but I'll say that it's going really well. We're buying from a person who's struggling. You know, and I'm not making light of that. I'm not making fun of that. I think so the answer would be yes. And have had some really fascinating things come across the desk, as I'm sure that you have in the past 3-6 months, where it's like, you know, deals that you're like, wow, like I was sent this deal and they were asking, hey, would you be interested in investing in it? And I'm like, pretty sure I saw this deal on the Wall Street Journal highlighted not that long ago. You know, and I think both you and I know which one that is. And that's, you know, we even sent a newsletter about it for our investing club back in Q2 when it first started looking like that was headed that way. And so that type of stuff is certainly happening. But I think that right now, what's really important is to, like, again, back to core fundamentals, you know, the team, the market, the deal, those three pillars, which I certainly did not come up with. Someone years ago, actually way smarter than me did. Like, those are the three ways you de-risk any type of passive investment in this wonderful industry that we happen to live in, right? And looking at a great market, there's nothing that's necessarily changed as to how I look at that. Looking at a great team, a competent team with a track record, the only thing that's changed there for me is maybe some learnings around how do you ensure that the team, like the GP team, the sponsor team, is there configured well for the marriage and not the dating, right? Can they go through this type of moment?
Yeah.
They don't have to be best buds, but they do have to stick together and they do have to see this thing through.
Yeah.
You know, that is so pivotal. And I think that, you know, I'm really grateful that we don't have any deals that we're involved in where it's like, I've seen that become an issue for real estate stuff. Right. But other than that, I mean, of course, everyone out there wishes that they could go back and including the entire banking industry and say, man, I wish that everyone kind of got a heads up from Jerome Powell that he's going to raise interest rates for the fastest and most dramatic, you know, hike in the last 40 years. I don't think no one thought that was going to happen that way. So
I just had that conversation right before you and I jumped on with another guy. It's like, it's easy to say in hindsight, like, oh yeah, well, of course interest rates were going to go up. But the smartest people in the world, like if you would have polled 1,000 of the best, the brightest economists.
Yes.
And this happened, by the way. They did poll them. They did ask them. And, you know, most people, yeah, interest rates were going to go up, but you're talking like 200 basis points. Like the more aggressive ones were like 300 basis points.
Right.
And then what happens? Like, and by the way, a lot of people said it can't go up. It can't go up more than a couple hundred basis points because it'll break the U.S. financial. Like we cannot pay back our debt if rates go, if the Fed fund rate goes up that high, like we can't pay back our debt. We're going to go bankrupt. It can't happen until it does. And then it happens. And then it does. And now, and so it's, you can't blame, I don't know. I mean, it's just, it happens. And if you're smart, but if you're smart about it, and I think a lot of people are going to say, well, I wish I would have been smart about it. But you get different debt and you underwrite your deals and stress them a little differently. And of course, now people are going, oh, well, I'm doing that now, but.
You know, and I got to just call it out because, you know, we don't get many opportunities to be able to say this in this fun. This is my favorite kind of nerdy conversation in the best way. You know, everyone out there who is touting fixed rates are the only way to go. It's a very fascinating to see how boldly they are stating things like this after being so sheepishly quiet for the last like 7 years.
Yeah.
So just to say like, yeah, fixed rates are great until you want to exit a deal early.
Yep.
Yeah, you know, and so not trying to throw blows here. I'm basically saying, you know, hindsight is 20/20 for everybody.
Yep.
And I think that right now, to your point, Todd, like there's incredible deals popping up right now, and the confidence and the courage, but also the long view stated as in a 5-year time horizon for a passive investor is going to serve them incredibly well. And so like we're getting so fired up about some of the stuff that we're seeing right now, because on the buying side, you know, on acquisitions and like looking at them as investments as a passive investor, I'm like, this is a unique moment. And we have no idea necessarily what's going to happen in the next 12, 24 months, big picture. But even if you buy the deal right now and you buy it at a discount, and it's discounted even back down close to or below 2018, 2019 price point levels, and you've got the debt structured well, and you're doing a value add plan, and whatever the deal happens to be, there's just so many great reasons to go take a look at some of the opportunities, because there's not that many. Like just because we're talking about this, it doesn't mean that there's thousands of great deals.
No.
You have to keep your eyes open and then pounce on them, and when they pop up, be ready to move. But don't this is not trying to be too soapboxy, but it's tempting to just sit there and say, man, do I love my T-bills, right? Man, do I love my high yield interest rates. Yeah, those high yield interest rates are still not keeping up with inflation. So
right.
In a savings account, to be clear. So that's my diatribe.
and they might have good cash on cash return today, right now, right? Compared to a lot of other things, maybe even that multifamily deal or self-storage deal. It's just like, well, geez, that thing's paying me 5%, and I can get this T-bill for 5%, but it doesn't have the value that it can create either. Like, so right. There's, you're missing on that too. So, yeah, it'll be interesting to see kind of how that plays out. But part of that conversation too was, and you mentioned this, is the people that are saying fixed rate debt was the worst decision you could have made for a long time. Right. Think about it. If you bought in 2018, when interest rates were right around 5%, 2018, you would have bought a deal at 5%, locked in at 5%. If you would have locked that in it for 5-10 years, and you didn't sell before these interest rates got up, I mean, that was a terrible decision, right? If you could have bought it and you did a value add, and you would have sold it in 2022 before interest rates skyrocketed, I mean, that would have been the best decision to have floating rate debt, and a terrible decision to have fixed rate. Not only do you have higher interest rate because interest rates went down, but you've got to pay these big fees that yield maintenance or debt. So it's like, that was a terrible decision. You probably lost millions of dollars because you made that decision. Right. And so it's easy in hindsight to just blame, oh yeah, look, these people that had floating rate, that they were terrible decisions. I'm so smart, but you were really stupid for 10 years leading up to this. You're not stupid, but you bet the wrong way, right? So right. So there's never a perfect answer. I don't think, but
you're nailing it, which is like, I just want to hit on this very briefly because there's so many wonderful threads I want to pull on there, but just selfishly, but it's fun to talk about, and I appreciate it, Todd. The thing I would say is the concept at its most fundamental that I have found very helpful, and the members of our investing club have repeatedly said that this is a helpful thing for them, is once again, so basic. It's like making a great decision on investing for me right now will always be a snapshot in time, because all you can do, any of us can do, is make the best decision with the information presented in front of us currently.
Yep.
So this is also why I really look at some of the, the told you so's out there: good market, bad market, bull market, bear market, whatever. Told you so's are an ego play for most people dropping them, for all people dropping them.
Yep.
And right now it's irrelevant noise. What matters is the financials and the team and the market in front of us at any given time, with the best and most robust set of information that we have available, period. And, I'll give a very specific example. Like, if I'm looking at a underwrite for a property, let's assume the team this is by far, for a brand new investor, if they happen to hear this, they've never done a single LP position or invested before, look at the spreadsheet once you've looked at the team. Like, that goes without saying. Hopefully I don't have to qualify that for folks, but the team matters way more than the IRR. You're over analyzing.
Yeah. If you're just focusing on IRR, you're focusing on the wrong thing.
100%. Right. And is the team first. Let's assume that the hardest part of the vetting is already done on the who, and you've looked at the market. Then, like, ultimately take a look at things that are present data measurable. Like, what is the team assuming for things like rent growth?
Yeah.
If they're plugging an 8 in there for annual rent growth, run, right? Like, it's just that's the stuff that in present day you can make smarter decisions on. I look back at 2020, COVID, man, that was a wild year. And people act like we haven't had any recessionary moments in the past decade. I'm like, hey, remember that time we all wore masks for a while? Like, remember that time that suddenly commercial real estate underwrites on multifamily went from having like 5% plus annual rent bumps to going to zero within like a month.
Right.
Like that happened. That was
Yeah.
3 years ago. Does everyone remember that? You know,
it happened
like,
now actually again.
yeah. And now here we are again. But like
Yeah.
fishbowl memory, and I'm guilty of it too.
Yeah.
But like, that it's so simple, at least when it helps me get back to baseline, you know, back to true north, you know, whatever the compass is in our minds that we want to get focused on for what is correct. And it's like, yeah, those things are measurable, whether it's a rent assumption on a value add deal. Sure, you can talk about cap rates all day, but like, that's really the basics. Like, take the information you can in the current circumstance. And I appreciate you going down that philosophical quantitative diatribe there for a bit.
Yeah. And what's important is that you're looking at, it's so easy to look at today and go, this is always going to be happening, right? It was so easy in 2021, 2022, early part of 2022, when rents were going up by 15% to go, oh, they can't slow down. Like, how can they slow down? Look at inflation. Inflation isn't running away. Rents are going to go up, right? Now, you know, many markets, especially in the South and West, like, they're going down, right? And we're not in those markets, but I'm sure there's plenty of people in those markets that are going, oh my gosh, rents are just going to continue to go down. I don't see any end in sight, right?
Right.
And you're just stuck in this moment of time, whatever's happening today, versus just looking and going, okay, what's reality here? Where have things been? How do they? Yeah, we have ebbs and flows, but we kind of know, like, rents go up 2 to 3%, depending on their market, all that kind of. Okay, well, if we're underwriting in a market that rents traditionally go up 2%, let's underwrite 2%. I don't care if it goes up 10% this year and -3 this year. It's just 2%. Like, let's just be smart about it.
Just be responsible about it. Yeah. God, it makes so much sense when you say it that way, Todd.
But it's so easy. I find myself getting caught up in that too. Like, I find myself, it's never going to end. You know, it's like, interest rates are just going to keep on going up forever. Like, you know,
right.
But it's like, well, slow down. Let's think about this. You know, it's so, everything is short term, and it all kind of goes back to the mean, right? It just does.
And unfortunately for all of us, humans are emotional creatures, man. And every single one of us, you know, you know, this morning before coffee, depending on how much my 5-year-old wants to have a tantrum, that's a special moment too, you know. But it's when looking at an underwrite, when like assessing a market's viability or long-term for buying a big asset that houses real human beings and families, you know, a big multifamily deal, or a place where Americans love to store our stuff that we buy, but we don't necessarily need, like a storage unit, but we keep paying for because we like our stuff. It's all of those basics are there. And I think the challenge for everyone, ultimately, as an investor, passive investor, is managing one's temperament. That's it. Yeah. That's it. Because frankly, none of the quantitative stuff matters if you can't look at it with an even keel. None of it vetting a partnership matters unless you can keep your temper in check. And, you know, none of the things matter about a great merits of a market if you're sitting there going, oh, but this is so exciting. Be like, got it. Glad you're excited. I get excited too. What do you see when you're not excited?
Yeah. Love it. Let's pivot. In Madison Investing, your company, you said it's an investing club. Like, explain to me what Madison Investing is all about and how you play a role in it. So let's first just focus on Madison Investing. Like, what is it all about?
Yeah. You know, this might sound a little bit old school. This became something by building relationships on a one-to-one basis, and still is now. You know, for the majority of the time that we've been around, we have, you know, more than a few hundred now active investors deploying capital alongside us with sponsors that we go out with our own money personally. Jennifer and I look at deals every week, and I say, okay, that's a team that I want to invest my own money with because we think there's alignment on our, you know, we have like a vetting framework just on the who, you know, and we put our own money in, and then we wait a few cycles so we can see, okay, how are those nuts and bolts looking? You know, is there clean financial reporting? Did they actually buy the asset that they said they were going to buy? Does it have an address? I'm joking, but I'm also kind of serious. All those things about, is there a predictable, repeatable business plan? And so we go out and we invest our own money, fly out and take a look at their assets and shake their hand, look, really look under the hood. And if that ends up working, then we'll start taking a look at their deals on a case-by-case basis. And we've done that now 45 times. And so, we try to marry, not date, not to use that metaphor again, but we don't just jump into active stuff with teams we haven't really gotten to know that specific way. And so it's become a matter of just building great relationships with people who are other passive investors, but disoriented by all the stuff we've been talking about a moment ago, Todd, which is like, there's just a lot to look through. There's a lot of noise. There's a lot of confusion, and I share my lens on it. And sometimes that's really helpful for people, and they decide to come along and do a deal that we've shared with them, with some of our partners. But by design, at the beginning of this journey, I very, very concretely decided I don't want to become a lead sponsor. And that was a formative decision, because a mentor of mine was like, well, what kind of state do you live in? I was like, what do you mean? He's like, do you live in a money state or a deal state? And I was like, well, I paid $430,000 for a duplex that makes $200 in cash flow. So I probably don't live in a deal state. My heart goes out to my people I know personally who work in commercial real estate in California. Of course, that is not a broad statement that condemns all, but I will just say that, within Madison Investing, it's just a pleasure and a privilege to have built trust with so many people across the country, with something that began really as us investing, and then ultimately trying to serve other folks that just don't have the time to get on a plane. They don't have the interest or willingness to dive into spreadsheets at this way, to go and meet sponsors in their market and walk properties, to go and nerd out on this stuff this way. And that's what we do. We'll share a small handful of deals every year to our passive investor group. And I've met every single one of our members myself.
That's really cool. So essentially you're kind of a set of checks and balances a little bit. They can go do their own research, and probably should do their own research on the sponsor, on the deal, on all that kind of stuff. But you've said, hey, I've also have some experience with these people, this company. We've invested with them in the past. Their deals have worked out in the past. I've looked at this deal and I feel like we're going to invest in this one. I feel good about it. And you're kind of saying, hey, invest alongside me if you want. Is that kind of how?
Exactly right. That's exactly right.
I think it's really cool that you're investing first in the deals. You're working through those deals. You're getting to know the sponsors before you bring them to your investors. That's, I would say, fairly unique, quite frankly. I talk to a lot of people that are raising capital for other people's deals. Some of them do it right, some of them don't. But regardless, I think most of them aren't spending a lot of time on that due diligence. They don't know the sponsors a lot of times until they do their second or third deal with them. But they've already raised money for those first, deal or two or three before they really get to know them. And they oftentimes have never met them. And the other thing that I tell people, so I coach, mentor people that are wanting to do this business. And a lot of, one of the easier ways to do things is to raise money for somebody else's deal, right? So a lot of them want to do that. And the biggest piece of advice I give people is, look, this is the dirty way of saying it, but don't be a prostitute. Don't go out there and find every last sponsor and raise money for them. You pick your one, your two, your three, whatever it is. I mean, you probably have a few more because you've been doing this a long time, but you pick your few horses and you ride with them. And like you said, you marry them. You're not dating these people. Your goal, it sounds like, with Madison is not to do one deal and never do one again. Now that might happen if you don't like that sponsor, right? But you're not bringing your investors to them either.
Right.
So
exactly. I mean, and I haven't heard that analogy for it before, but I mean, frankly, the concept I completely agree with of what not to do.
Yeah.
It's ultimately something that is the path that I think is the most appropriate, that we have very dogmatically adhered to, is the boring one. Is the best kind of boring, and
Vanilla.
It's vanilla, and done right, it should be,
Yeah.
it should be, it should not be exciting. When the thing exits, I'm grateful we've had 13 exits to date. But of those, it's, those we celebrate, and we're so excited for our investors when we're like, hey, that went really well. Let's go, you want to go do that again? And they're like, yeah, because that's the moment, right? It is ultimately the time when it's fun and celebrate at the end of that hold period. But it's incredibly disorienting, I think, especially right now, when you've got so much noise in the market and so much exuberance of people who are jumping into this space saying, oh, I want to go be the next big sponsor, or I want to go work with the next big sponsor, so let me go highlight their deals. And it'd be like, best of luck to you. A lot of people doing that. And it's an industry I have come to love. But what I think I don't love is, I don't love the fast and loose dynamic. I don't love, rushing through any kind of like deal process for someone. These are big decisions. And sometimes I think people lose sight of that. These are big decisions for folks, whether, it's a 25K check. That's a lot of money for the average person. That's a fortune for most humans on the planet.
Right.
But I would say that for people cutting, $500,000 checks and above, we're grateful to call those ones partners, but that is it. Every dollar matters. And that when it comes to working in this industry, it's just important to remember all that. These are real deals, and the rigor matters. The patience matters, and good relationships with real long-term partners matter.
Yeah, for sure. For sure. Man, a lot more we could talk about, but I got a couple questions I want to ask you before we wrap. What's a mistake that you've made, or maybe even something that you've seen made, but what's a mistake and how have you learned from it?
Yeah. How many do you need?
Just one, man. That's the hardest part, is just coming up with the one, right?
Yeah, it certainly is. I think that you kind of hit on this when we were chatting about taking time, getting to know people, and the basics of trust building, getting to know people in person, getting on Zoom calls as needed. It's never wise to rush that. And I think that one of the mistakes that I will have made in the past, and this is actually on a personal investment that we made, this is, a ways back, was taking someone else's word as to the viability of a sponsor, right? And of their track record, of their ability to go execute. And I think looking back, again, this was a personal investment that we made, but it was okay, no, it has to be done. It has to be done by us. It has to be done by us firsthand. And I think that that's the kind of stuff that really, really matters in terms of mistakes. I'm not going to go into the tech career stuff because there's 1,000 different things I've learned. Managing teams of 200 people when you're 26 years old and not ready for it is the definition of being over your skis. So that's how you learn really fast, though.
Yeah, right. Is it our tech in the tech industry? Are people willing and open to look at real estate as an investment, or is it, because there's some industries I feel like it's just 401ks, you're an odd duck if you're doing something different. Is that the case in the tech industry, or is it a little bit more open? Is it difficult? Because I would imagine that's a good amount of your investors. Is it a lot of training to them, or is it they're already pretty open?
Okay, that's a good question, Todd. I really think so. To your point, half of our group at least is tech industry folks from across the country too, but heavy on Bay Area at first.
Yeah,
that's how we started. That was my network, right? So the challenge is primarily two reasons that is tricky, or there's a friction point, two friction points for most tech people, not the people who have already gotten deep into reading Rich Dad Poor Dad. Those people are the ones who are further into this wonderful rabbit hole.
Yeah.
For the average person, number one, angel investing looks way more sexy, doesn't it?
Yeah. Yeah.
It's great to say, let's get a 25x on my multiple on my dollar.
Yeah.
So if anyone wants exciting rocket ship, high failure rate, extremely high potential return, they're going to be bored out of their mind by a predictable 2x equity multiple with some great tax benefits and some cash flow, won't they? So that was the first one.
Yeah. That's the one I thought that you would say, is that, like, look, a lot of these guys and gals, like, they're used to seeing, like, they've heard the Amazon story. Like, that's what they want.
Right. And no judgments. Seriously.
Yeah.
It's just, that's outside the area of my core expertise professionally these days. Have I done that? Yes. Have I deployed capital? Yes. But that's number one. The second one, and this is going to be my absolute best attempt to convey this in a way that comes across as completely Switzerland neutral, is being over a massively strong IQ and a data science background makes someone extremely confident in their ability to analyze. They are a definition of a quant. Being a quant has zero relevance to vetting the competency, playbook, track record, portfolio management capabilities of a real estate sponsor.
Yep.
If a person can't get over that, and they often do, but if they can't get over that, they're going to have a hard time putting together a portfolio they're proud of if they want to passively invest in these asset classes, right? And I know you know this, but you can over engineer a spreadsheet all day, but again, it comes down to all of those wonderful things that go into managing an asset.
Yeah, I mean, we don't have that many people in the tech industry. We do have a few, but that's just not our niche. But we do have a lot more that are engineers, and they are the same way. Just that over analytical. They're just looking at every single number. Hey, what about this number on this one line item? And it's like, that's what you're focused on. We might be off by $4 on that. Yes, you're right. We might be off by $4, but that's not going to wreck the deal.
Right.
Take the 15.3 projected IRR, and now it's a 15.29. Is that going to make the deal or break the deal?
Whereas, just to give a very specific, response to round out the effectiveness, if someone happens to perhaps be in that profile and they're listening to this going, man, these guys are jokers. They should overanalyze that cell more on that spreadsheet. Take Texas, what was it, 2021 Q1 deep freeze? I think that was 2021.
Yeah.
How much does that cell on that spreadsheet matter if you have sponsor A, same spreadsheet? This theoretical sponsor A owns a self-storage facility and or actually even better, multifamily property. Like, we were in a couple of deals that exited really well, killer equity multiples at the end of these deals. These investors are very happy. The Texas deep freeze caused pipes bursting across dozens of deals. I know this because I sent the emails out to our investor base, which are not very happy, all those exited deals. And that cell on that theoretical spreadsheet can be off by $4. How much does that number matter when the sponsor A knows what they're doing and how to react within a 24-hour period to get the response in place? Sponsor B, maybe they had that number right. They've never done it before. I'd rather be with sponsor A.
Yep.
And I know I'm just beating the dead horse here, but I do think that it's just so incredibly common. Does the spreadsheet matter? Of course it matters. Of course it matters. It matters a lot to the bank too. But it matters immensely more. All of those capabilities and repeatable processes and failure response, the ability of someone having gone through hard stuff like you were asking about earlier, Todd, like, what are they going to do when the fit hits the shan, right?
Love it. Favorite book?
Got to give it to Essentialism by Greg McKeown.
I think that might be a first on this show, so I've never heard it, but great. I love hearing new books.
Yeah, it's so business book. I've gotten through it 3 times now over the years. It hit for me. And there's probably a couple others that do this well, but for me, why it mattered at that time when I first got my hands on it in like 2016, 2017 was it gives you at least 5 ways to say no and keep your social graces intact. I think the first chapter starts off with, this is a shocker probably for folks, but like it's a tech founder telling a story about why he had to leave the birth of his son, I believe, because he was just so in the wrong side of all of that balance wise in his life. And it hit for me at that moment when I was working like 80 hours in office a week and also trying to go learn all this investing stuff. And I felt like I had a toddler son and another one on the way. And I was like, I need to start clearing out I need to clear out some time and focus on priorities. And so I think that is where most people miss out on their potential, honestly, for life, not to go 0 to 60 on it. It's just, I think it's hard to say no. We don't want to let down our friends. We don't want to say no to dinners and coffees and, going to concerts and all the fun stuff that I love, man. But you don't, whether you're the Pope, you're Oprah, you're the president, whatever, like it's all the same 24 hours in a day. And we got to find our way to focus on what matters.
Yeah. Love it. Love it. Last question. What are your 3 pillars of wealth creation?
I was thinking about this a lot. So I didn't want to mess it up. I think first and foremost, multiple income streams. I have to say that first because it was something I didn't understand for so long. Big money from one job, from one employer, you don't control that income as much as you think you do.
Right.
Go add more. And that's what we've aimed to do over time. The second one would be about leverage. And this doesn't mean a loan. What this means is figuring out how to leverage there's so many great social media content creators out there that are hitting on this topic. I got to call out Hormozy because he probably made it the most branded packageable out there, but there's different forms of leverage, and like figure out how to generate and grow your wealth using leverage, whether it's leveraging your expertise that is unique to you, whether it is leveraging time and figuring out how to make more of it to focus on where you can generate more wealth for your family and the people that you are that you're going to do right by, whether it's your investors or your family. The third would be, oh man, I mean, just got to say it. I'm not going to try to sound too Dave Ramsey here, but I'll just say like, you got to make sure that you don't bite off more than you can chew. It's a bit of a frugality comment, but I'm not like a fire movement person to the financially independent retire early where you live on a shoestring budget either. I just think that if someone sits there and asks themselves truly like, what is enough? Right? Like what is enough? Like what, like for our family, for our lives, for if you don't have kids, like what is enough? Man, as a guy who turned 40 in this year, I got to say, I don't need as much as I thought I did when I was 20.
Yeah.
I'm a pretty simple dude in a lot of ways. And I think that not everyone gets there. I don't need a jet. I don't need a yacht. What I do want is as much maximum flexibility as I can, optionality with my family, spend time with them, to go on a 6-week living experience in Portugal this summer. What is enough? And that tends to get me back to center on not wanting to go buy another guitar, not wanting to go and, buy a car or something. So that would be it. Sorry for the long-winded breakdown, but give some color.
Well, I think that last one definitely has to do with where you want to go, right? If you need the jet, if you need the yacht, and I'm the same as you, like, I don't, not only do I not need that stuff, I don't want that stuff, but it doesn't matter if you do want that stuff, if you do need that stuff, it looks different, right?
Right.
You got to go a little farther. You got it, right? But you have to know just because somebody else wants it doesn't mean that that's where you need to go.
That's right. At least, and by all means, if you're listening, be like, man, that guy doesn't want me to buy this toy. Be like, not the message. The message is whatever makes sense for you, but take the time to figure that out.
Yeah.
And I have zero answers to the existential challenging question of what is enough. Like, I don't know, ask me every morning. I'll try to give you the best answer I can.
It might change. And it's going to change throughout your life too, right? Enough is different and looks different at every different chapter of your life, which you're going to go through many. I already know I have, and I'm basically the same age as you. And it's like, you're always changing. You should be. Hopefully you are.
Yeah.
So
it's a beautiful thing. It's one of the best parts of being a human, right?
Yep. Love it. Well, Spencer, man, this has been great. I think we could definitely keep going. It's been a great conversation. Appreciate you being on the show. How can our listeners get in touch with you, learn more about Madison Investing, and connect with you?
Yeah. So we have a website, madisoninvesting.com. So folks can go there, check out what we're up to, and, sign up for our investing club. You will have to just talk to me. It's a way to get to know each other and actually build a relationship that we were talking about earlier, Todd. Thank you. Thank you. This was a blast. We got to cover so much ground and stuff that I love to nerd out on. So hopefully it's valuable for folks.
Awesome. Again, really appreciate it, Spencer, and you have a fantastic rest of the day.
You too. Thanks, Todd.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.